Good morning, everyone. This is Marshall Giller bringing you the morning comment for November 18th. The dollar recovered generally against most of its G10 counterparts on Monday after falling precipitously on Friday. Much of the movement seems to have been just mean reversion. For example, the Kiwi and Australian dollar were the best performing currencies on Friday, but they were the worst performing currencies during the European day yesterday. FX seems to be in the spotlight nowadays. The wild movements in our market, for example, Euro-dollar trading in a 1.1% range yesterday, dollar-yen having a 1.4% range, are in sharp contrast to the U.S. stock market, which once again closed with less than a 0.1% change on the day. Now, the dollar's strength may be more of a result of process of elimination investing than anything else. With Japan slipping back into recession, there's little, if any, chance of that country cutting back on its quantitative easing program anytime soon. Meanwhile, ECB officials yesterday showed their resolve to do whatever it takes to get the Eurozone economy moving again. ECB Executive Board member Yves Mersch, a noted policy hawk, gave a speech devoted to asset purchases. It was the first time that one of the ECB hawks has given such a detailed discussion of the possibilities for quantitative easing. Then, ECB President Draghi said the central bank's ready for further stimulus if its current efforts aren't sufficient to accelerate the region's recovery. Net, it's clear that the ECB is rapidly losing its aversion to extraordinary measures, just as the U.S. is embarking on a normalization of policy. This world-famous divergence in monetary policy between the U.S. and other countries, notably Japan and the Eurozone, but Britain also to a degree, is likely to be a driver of the FX market for a considerable length of time, in my humble opinion. During the European day, the highlights will be the UK CPI for October and the German ZEW survey for November. The UK CPI rate's expected to have remained at 1.2% year on year. That could push further back the expectations for Bank of England tightening and could leave sterling under selling pressure. In Germany, the ZEW current situation index is expected to have declined along with the situation there, but the expectations index is estimated to have turned positive. Now, the low levels of the indices will confirm once again that the Eurozone's growth engine's still facing problems, although the improvement in the expectations index could be Euro positive. In the U.S., both the headline and core PPI rates are forecast to have declined in October. That could be negative for the dollar. On the other hand, the NAHB housing market index for November is forecast to increase by 1 point. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.